Good morning, everyone. Today, we're going to kick off a day with a panel on navigating structural shifts, regime changes, and macro shocks. My name is Stas Melnikov, and I lead quant research and data solutions for Stas. My team provides daily forecasts of corporate credit and does modeling of corporate credit, interest rate, and liquidity risks. On this panel, we have experts covering full spectrum of perspectives, ranging from macro to market microstructure level, so it should be an interesting discussion. Let's start by doing a quick round of introductions. Breanne, can we start with you?
Sure. My name is Breanne Dougherty. I work for Bloomberg. Specifically, I'm the head of thematic strategy within Bloomberg Intelligence. What that means is we're basically redefining the equities landscape, something that when I entered Bloomberg Intelligence a few years ago, we were looking, to build out an equity strategies group specifically through a thesis-driven lens. And we've done that through this category building product with over 2,300 equities mapped to themes as opposed to sectors, and really being able to drive a new type of equities research on the global market. So that's what we focus in, everything from AI to grid tech to genomics to novel neural mental health. It's been a really fascinating ride, and hopefully we can provide some great macro perspectives because of that.
Hi, morning. My name is Judy Sku. I work for Scotiabank. I oversee the equities and FX market making. So we work in low latency, high frequency infrastructures and market making bids and offers to clients. And in this area, we look at microstructures, volatility regimes, and minute by minute return structures in a very low latency space. We adopt AIs and machine learnings to help us navigate through those space.
Morning, my name is Igor Yelnik. I manage a company called 𝐴𝐼𝐧𝐯 Capital. We're based in London, and we manage a systematic global macro fund, which is uncorrelated to other systematic macro, to other hedge funds, to major asset classes like equities and bonds. And the way we approach the strategy is like exact opposite to what Judy is doing. They are very fast in their trading, and we are extremely slow because we look at macroeconomic indicators, we look at fundamental data, among other things, and quite a lot of our risk is concentrated in relative value models rather than in directional models.
I'm Mark Shore. I'm an economist at the CME Group in Chicago. We only have 2 economists, so 50% of the team is right here up on stage. I started with the CME in July of last year. Prior to that, I was finance faculty at DePaul University, primarily teaching courses on risk management, alternative investments. But I spent most of my career in industry. I started on the floor of the Chicago Board of Trade, working both in the bond room and the grain room. And last year, I defended my dissertation, which is on alternatives, and officially became Dr. Mark.
Thank you for those introductions. Let me say a few words to set the backdrop for our conversation. So the 2020s have been quite a decade so far. We had the COVID-19 pandemic, we had the rapid advances in AI, we had launch of ChatGPT, which ultimately marked a structural shift across virtually every risk and return dimension. At the same time, we had reemergence of inflation, rising interest rates, and continuing fiscal deficits that place us in quite an unprecedented space from a government debt level perspective. Asset prices have gone up, stock markets notching new highs, corporate credit spreads are at the bottom decile of the historical range. Everything seems to be priced to perfection. The expectation of continuing advances in productivity driven by AI, automation, quantum, fusion, biosciences, to name a few themes. It's an exciting time to be alive, but where we go from here is far from certain. So looking at our corporate credit models, if you just look at the top 3,000 companies in the United States, we are in 71st percentile from a median 1-year default probability perspective, with the first percentile being the lowest and 100th being the worst. If you look at the 3-year default probability, we are at the 54th percentile median. So this type of environment is typically consistent with a late-stage credit cycle, which is not what markets are currently pricing in. So at the same time, we also see the pace of meaningful events have accelerated, and what is even defined as a meaningful event has changed quite dramatically. So we have lots of signals. Those signals are coming in fast, and separating signal from noise can become a challenge, which is what we are here to talk about, which leads me to my first question. What are the top themes, topics, and data points you're currently watching to help navigate this uncertainty?
Do you want me to kick off there? Sure. I heard, I wasn't here yesterday, unfortunately, but I did hear that this was a big topic of conversation, and I think there's probably some divergent views on this. When I look to what we're eyeing most closely for 2026, actually, it's very much steeped in our biggest thesis that there is, which is that looking back in order to identify trends of today is a little bit difficult. And actually, when you keep looking back to, was it the dot-com bubble? Was it 2021? Was it the great financial crisis? That every single time we look back there, the circumstances aren't the same right now. And so we're really looking forward at what the current structure looks like. Heading into 2026, something that we're eyeing really, really closely is that we are seeing such a disruption from the fact that we've got tech investors, be they actual investors who just traditionally focus in tech, or be they actually technology companies, driving incredible capital towards industrials, materials, energy. This is driving new correlations, and those correlations have been quite dramatic in the way that they've advanced over the last year. We are seeing, for instance, Siemens Energy have, just as high a correlation to NVIDIA, actually higher than some tech stocks even. And this is what we're watching going into 2026. Because while that spells opportunity, right? We do identify that there's a lot of bottlenecks in the system, and that the proliferation of innovation and technology is very much tied to the debottlenecking of some traditional infrastructure. What I think that's going to bring in 2026 is some real tension, right? Tech investors, they love the quarterly earnings, right? A lot of near term is when you think about tech investing, innovation investing. Well, that isn't necessarily the same type of profile that you need to be looking for when you're talking about industrials, materials, energy. Those are longer term build cycles, right? So I think some of that tension might start to play out where we've got a whole bunch of investors who are moving into those types of spaces who are going to be so focused on, how this innovation cycle works through in 2026, and that could spell some volatility for a big portion of the market.
Awesome. All right.
Judith,
Take
you
it
want to
next.
add to that?
Yeah, sure. So in a high frequency, low latency market making space, we're not just looking for volatilities, but also regime changes. The persistent volatility clustering is making us to rethink our quoting logics and inventory risk management. And microstructure discontinuity just contributes, amplifies the dislocations in the market. So we're using and also regime shifts in the low latency space. It's not just days, weeks. It's actually minutes, seconds, milliseconds, or sometimes microseconds. So we need to devise methodologies to prevent cascading, exacerbating cascadings due to clusterings, and also watching for opportunistic mean reversion opportunities.
From our perspective, as I said, we are a systematic manager, and we model macroeconomic processes and their effect on the markets. So when you do this, you are naturally limited to the data which you have had, which is related to the past. And inevitably, you face a situation where some events which you don't have in your history are pretty much unmodelable, and an earthquake may be a good example. Who knows how your portfolio is going to react if there is an earthquake in Japan tomorrow? I mean, if I know my positions today, I can say that. But if I don't know my positions, if I'm looking like 1 year into the future, I don't know how my portfolio will react to an earthquake in Japan. Now, the problem is that such earthquakes, quote unquote, happen all the time. They may be like bigger earthquakes, like small trembles, but they happen all the time, and they do not have to be earthquakes, literally. It may be some decisions by central banks, governments, wars waged and stopped, and credit crisis which come out of nowhere, you name it. And another thing is that it's hugely important how central banks and Fed first and foremost react to such crises. So it's very difficult to say what will be the next big thing. Who would have said that, let's say in early 2024, that we will have a crisis in Japan in July, August 2024. It was virtually unthinkable. Everything was very calm, everything was cool. And then all of a sudden, the Bank of Japan indicated that they would tighten their monetary policy, and topics lost 10% in one day. So I think what I'm trying to say is that you never know in advance what is going to happen. And for me, as a systematic manager, the important thing is not to predict where the next earthquake is coming from. For me, the main thing is to make sure that whatever the earthquake is coming, my portfolio should be ready to withstand it and preferably make money. But if to lose money, then not lose too much.
So there's a few themes I'm looking at. As an economist, there's never a shortage of themes. So I kind of use like the overall umbrella theme of what's old is new again, beginning with unemployment. So that's come off its lows. We're starting to see that move a bit higher. And the official unemployment rate is 4.3%. That is the U3 rate. If you're not familiar with it, the US actually has 6 definitions of unemployment, creatively called U1, U2, U3, U4, U5, U6, right? So U3 is defined as people who've been looking for a job for the last 4 weeks. I like to look at U6, which is the widest definition. That includes U3. It also includes people who've taken part-time work because they can't find full-time employment, and people who they've just given up. They've walked away from the labor market, right? That's U6. That it went from 7.9 to 8.1%. When you see a slowdown in the labor market, you will see the spread between those two widen, which means U6 is accelerating faster than U3. So we're starting to see some of that happen now. Another one is inflation, right? So inflation went up as we came out of COVID, came back down, but it's now starting to go up. And the question is, are we headed towards a second wave of inflation? In the 70s, we had 3 waves of inflation. We may be heading for potentially a second one, but you are definitely seeing it start to move higher. Whether you look at CPI, PCE, every subsector within it are all now positive. Prior to 6 months ago, the services part was usually positive, and the goods part was usually either flat or a little bit negative, but now they're all moving higher. The last part is volatility. So what's interesting, like if you look at VIX relative to equities, that it moved higher in April, it got up to 50s, 60s, came back down. Its normal range is on the low end 10 to 12, its high end is somewhere between about 17 to 22. Since it came back down, it's been consistently 15, 16, 17, and then making some pops higher. So what's that telling me is that the option traders are pricing in some added risk that the cash market is not pricing in. Also at CME, we have our own volatility indices called CVOL, which covers many asset classes. One of them I've been looking at a lot lately is with treasuries. And so there's several metrics that you can bring out of CVOL. One is the volatility itself has been decreasing. It's been getting smaller and smaller. The other part is convexity. That's been increasing. What that tells you is that there is more variance at the wings of the strike prices versus at the money. As that increases, it basically tells you that the market is uncertain of where it's going. So you're getting the volatility coming down, you're getting uncertainty going up, which could, in essence, tell you that there could be a breakout one direction or the other within treasuries.
Mark, may I ask you one thing? As far as I remember, the median level of VIX is about 18, 19. So VIX at the level of 15, 16 is actually below the median. So it's not like the market is pricing something significant. In my opinion, on the contrary, the market is pricing calm. What do you think about that? And then another thing that you said, in April, VIX went up to 50, 60. It did, but it was an untradable level. The tradable level was somewhere around 30, 35.
So the way I look at that is that when you talk about the median, you're talking about all the pricing in there. I'm talking about just the normal range that it trades within. So when it, because it tends to be in contango most of the time, right? And it'll the low end is 10 to 12. When it bounces up to 1722, that usually burns out and then it comes back down into its trading range again. But what I'm looking at is that it's consistently staying at the top end of its normal range, which is saying there's some nervousness in there that is not being priced into the cash market.
Okay, thanks.
Yeah, so there are lots of interesting themes being identified, starting from the tech spend and the dependence on the tech industry and where that capex is going to go, and that ultimately drives your winners and losers. On the market microstructure level, the behavior of the volatility is changing. The way the regimes are shifting is constantly evolving. We have Federal Reserve and the Fed put, and whether that it still exists or not going forward, with QT ending, and with other kind of macro themes unfolding, undoubtedly being influenced by geopolitics. The unemployment, the inflation. I mean, inflation. The consensus view seems to be that the inflation is going to abate, which seems hard to believe. So there are lots of perspectives where I think market may be mispricing some structural shifts and forces. So, in your opinion, what is currently being mispriced, and what would make you doubt your belief by Q1 26 if you were to see evidence to contrary? Igor, can we start with you?
Yeah, sure. In my opinion, the market is very optimistic about inflation. Very optimistic. I can't see any way out of this particular macroeconomic situation rather than through inflation. The Fed and other central banks in the developed world will have to print more money, infuse more liquidity in the market one way or another, and it will lead to inflation. The job market is one problem, the debt and the persistent deficit is another problem, and there is no other way out rather than to inflate this debt out. I simply can't see it. Nouriel Roubini was speaking yesterday morning here, and he said, like, guys, it's all good, because with the advent of AI, we will have additional 2 percentage points to our GDP over the next 20 years. Yeah, if he is right, then all is good. But the problem is that no new technology added 2% to the GDP over the 20-year period. So it was quite a bold assumption. And if I think about the past improvements in technology, then probably it's still going to be inflation. And therefore, I think that the bond markets are pricing a little bit too low inflation. And I don't think that the equity markets are so wrong, because the more money is printed, the more they go up, and the more incredibly ridiculous the valuations become.
I mean, we're most indebted that we ever been as a modern human civilization, so it certainly adds to market fragility and perhaps adds some opportunities as well. But from a macroeconomic perspective, Mark, what are your thoughts about where some of these mispricings are happening?
So I think part of it too is early in the year you had the sell USA concept, right? Whatever it's related to the US, equities, dollar, just sell it.
It was a good trade.
However, if you look at, say, like the foreign holdings of US debt, it's actually continued to move higher. That hasn't changed, right? So people aren't walking away from going long treasuries. However, the composition of who is owning it has changed a bit, right? China has always been known as being the largest foreign holder. Really, that peaked out around 2016, 2017. They're now in third place. Japan continuously kept buying U.S. treasuries. They now are the largest holder of debt. Then you have UK, which is number 2. You have China, it's number 3. And China basically reduced their allocation by roughly about a third from about 2016. And then oddly enough, number 4, you have the Cayman Islands. And you kind of wonder, well, where is that coming? Is that offshore money? Where is that coming from if they're in the 4th place of that? But I would see that as being one of the things that is not changing, that it's the selling of America is not happening.
Judith, from your perspective on the microstructure level, what are you seeing there that may be not captured by the current kind of consensus opinion?
For sure. So in the microstructure, low latency, high frequency space, we saw the market often underprice the persistency of regime changes and overestimating mean reversion. So our model shows based on 𝐸-𝐺 and econometrics models, the beta to persistence of a regime shift and stay there is a lot longer than usually what market priced in. And so unless we're told we have evidence from market, like after shock, a major shock, the level of liquidity just goes back to normal after few sessions, or the realized volatility just goes down, decays quickly, we stay with our model beliefs that the volatility changes during regime shift is a lot longer than market expects.
Yeah, the wrongful expectations of mean reversion have cost a lot of investors money over the last couple of years. And yeah, you also mentioned the 𝐸-𝐺 and just in general volatility detection. I think this is where one of the areas where AI can do a really good job, because it's really good at detection, less so in prediction. So it's a fascinating area to be in. So Breanne, do you want to round us up in terms of the themes that that come to your mind?
So many. I'm going to start a couple things, and I'm actually going to punt something to the new doctor actually on your dissertation in a second as well. But I'm going to shy away from saying mispriced, because I don't think it's that it's mispriced, but something that I'm watching really closely, and we have seen this evolve over the last few years that we've done this work. Right now, when we think of all of our stocks that we've mapped to themes, so again, we're talking AI, modern defense, obviously, which has done really, really well in 2025, genomics. Over 50% of those equities that we're capturing and we see are being powered or involved in really powerful secular growth trends that are, 10-year, 20-year type cycles, they are trading above the 5-year max of their respective regional sector benchmarks, right? So premiums are migrating to innovation. Premiums are migrating. Now, those stocks also are showing really high earnings growth expectations, right? There's definitely backed by something, but we are basically seeing the sector binds that tie, right? Those traditional ones that have been out there in the market, they're starting to disintegrate. And investors are investing in a very different way and eyeing the market from a much more what we believe to be thesis-driven approach. So that's going to change the way your portfolio is built, right? You've maybe traditionally looked at a sector allocation. Well, if everybody's migrating away from a traditional sector allocation and more towards a thesis-driven or thematic allocation model, that's going to change the way how these equities trade together, right? So it's not that it's mispriced. I think that we're just at a really interesting inflection point where investors are eyeing the landscape differently. The other thing that I think I'm watching really, really closely in the work we do, I look across public equities. I track funds really closely as to how the ETF landscape is contributing and how people are participating in thematic investing through the ETF landscape. I also track private companies that we also view as being thematically inclined, right? Or involved in the themes that we're tracking on the public and also in the ETF space. We are seeing a rising liquidity in the secondaries market. So this is where I'm going to punch you on alternatives, is this shift of more and more investors really seeking to dive more heavily towards alternatives in many different ways. And how I think that investor appetite is actually, again, going to be shifting the way public markets are trading, the way investors are engaging in private markets, unlocking potential opportunity there, or potentially increasing risk there as well. All of this is meaning that we're at a really interesting inflection point, I think, for portfolio management. And I think that has the capacity to actually have a decent impact on how markets actually evolve.
Well said. I think the line between the public and the private investments is definitely blurring quite rapidly, and it brings a very interesting perspective to the asset allocation where we're in right now. And since this is a multi-asset panel, so let's talk a little bit about asset allocation and go back to the basics to think about the regime shift. So For most of this century, we had a kind of your typical relationship between risk and risk-free assets, between stocks and treasuries, where you have a negative correlation. Something bad happens in the economy, expectations, then you have flight to quality, and that has worked well as diversifier. And then we had inflation. And the inflation changes this correlation. It changes the sign of the correlation. So now, when the inflationary expectations drive the market concerns, you have a positive correlation between bonds and stocks, and that obviously does not work well for diversification when you need it the most, and that's what we witnessed in the early 2020s. So now the correlation kind of went back to zero. It's unclear where we go from here, but does this mean that traditional 60-40 allocation or the allocation to a treasury sleeve as a downside hedge is dead? I really need to be looking about that differently. So, Mark, perhaps we can start with your perspective on that.
Sure. I wouldn't necessarily say it's dead, but maybe it's intensive care. But yeah, I mean, I've been in the industry for several decades, and right now I've seen this slow process of people going from purely stocks and bonds at 60-40 and moving more towards alternatives, right? And it could be private equity, hedge funds, commodities, managed futures, real estate, private credit, whatever it is. But there's a very wide spectrum of where people can go. One of the things I look at, and actually my dissertation, I focus primarily on CTAs and hedge funds and their correlation, and how do you use that as a tool within your framework of asset allocation decisions. So you can make a decision, or you can make an argument for any of these assets to be in your portfolio. The question is, what's the goal of the investor, or what's the mandate? What's going to fit their portfolio best? So if you look at just, let's say, hedge funds, there's a lot of different strategies. For years, I would hear people say, or an investor say, I'm in hedge funds, therefore I'm diversified. Not necessarily. It depends on which of the strategies you go into. Some are more heavily correlated to equities, some are more diversifiers. So if you look at that, if they want an extension of their equity exposure, they go to the ones that are more heavily correlated. If they want more diversification, they go towards the bottom that are least correlated. And if you start looking in that method, that starts to give you a better idea as to where you can go. Now you can take that then beyond hedge funds, take it to other strategies. But if you think about just generally, there has been this increasing move towards alternatives and going, there's much more out there in the world beyond stocks and bonds. As a professor, because I also teach it at DePaul University, one of the classes I teach is on alternative investments. Most of the students know nothing about it, right? They come into class, they know stocks, they know bonds, but they don't know about any other asset classes. And they start to learn about it and go, this is really cool. There's all these other places we can go and potentially find opportunities.
Anyone else wants to opine on the topic?
Yeah, sure. So first of all, I fully agree with Mark. The most important thing for the investor is to understand what he really wants from his portfolio. The goals have to be very clearly understood and articulated. Without it, we can speak about asset allocation all day long, but it's pretty much a useless exercise. Now, when we look at the landscape of US investors, especially US institutional investors, we can see that 60-40 is pretty much alive, unfortunately. And not because people know what they want from their portfolios, just because of legacy reasons. And unfortunately, it very often happens that the level of competency in those boards and investment committees is insufficient for diversifying properly. Do they need to diversify? Yes, absolutely. Absolutely, because 60-40 is a thing of the past. Most of the risk in your 60-40 portfolio is concentrated in equities, because equities are significantly more volatile than bonds. And they do need to add something to make their allocations more stable, to increase their solvency ratios, and so on. What we have seen, however, and what Stas alluded to, is that much of the alternative allocation has gone to private equity and private credit. Private equity is still equity. Private credit is still credit. And for many people, allocations to those private assets are justified by the by the absence of volatility or perceived absence of volatility. This is outright wrong. When you have private equity, you still have volatility. It's just this volatility is hidden from you. You are not seeing it. It's not marked to market. But nevertheless, you don't assume that when you have stocks of, I don't know, Microsoft, they are volatile. And when you have stocks of, like, you have a share in a private software development company, which is like 1 million times less than Microsoft, you have no volatility. This is ridiculous. So I think that when you think about diversification, when you think about alternatives, you need to think about what you are actually buying and how it's going to help your portfolio achieve the goals which you have understood and articulated.
Yeah, that's an important consideration. We can have a whole panel on that topic alone. But just being mindful of time, I wanted to just shift gears a bit about, we talked about 60/40, and that's, you know, an example of a model where you extrapolate a correlation and, you know, that model ends up being wrong as a regime shifts. So what are examples of other models that you see that didn't work through 2024, 25, and what replaced them? So maybe Judith, if we can start with you on that one.
Yeah, sure. So in my space, we definitely find especially in FX, the pure econometrics model or static quoting doesn't work. In regime shifts, in volatilities can just change on a dime. So we got into ensemble models and doing different versions of modeling, from econometrics to machine learning to AI. And AI is not just in modeling, but also in feature extraction. We can use a convolutional neural net to use computer visions to look at the microstructures that cannot be captured or missed by human eyes. So we mix all those models, and then recently there was a paper from 𝐶𝐶𝐻𝑇able. They actually agreed with our thesis. They looked at neural net, LSTM, and recurrent neural networks, along with techniques like attention transformer, which is behind a large language model. They found it ensemble of those different neural nets that gives a better picture of intraday volatility, intraday returns and volatilities. And we're on the same page of that. So just looking at a pure, even just multivariant models, are very sophisticated versions, they half the time they don't do as well as the random noise.
Yeah, I give my vote for the ensemble models as well. Just thinking back to the global financial crisis, I was running home price forecasts, and ensemble models whole-handedly outperformed each individual model. And also it reminds us that the AI existed decades ago, is just now starting to become popular at the front lines of everything. Anyone else wants to chime in on the model topic?
I would say, just on that AI, something that I think is a conversation that I'd like to keep bringing up everywhere I go, and I have it with CIOs all the time. I think some people underappreciate how much noise comes in because of AI and the data being generated and using the LLMs. I mean, we use it a lot in the work that we do, and it does give a giant vote for the need for humans, right? So the point being is that companies themselves are very smart about the types of words that they're leveraging within their own earnings report. Obviously, now people are leveraging models to help extract as much information as possible from these, you know, company reports that are being put out. So everybody's working really hard in order to gather those data points. Well, that can bring a lot of noise into it, right? And the effort, the cost into cleaning data, critically important. Understanding what your data is doing is critically important. And I think that is something that a lot of research shops, a lot of PMs, everybody's trying to really work through right now, is where to leverage these tools, but also what kind of controls you need to put in to make sure that you're using the power of them in the appropriate way. And that has been something that I think has been a real learning curve for us, that with every new advancement, I mean, yes, AI existed X number of years ago, but the power of it is so much more right now. and being able to leverage it, but also be responsible with it and being able to really dislocate the noise from the types of information that you're going to want to actually use, to drive your actual models, and being able to identify and adapt as you see new noise kind of enter into the system.
Oh yeah, 100%. I just want to emphasize this is such a great point. More data doesn't mean better data.
So true. Sometimes I wish I had less data.
Right. And also, even data cleansed doesn't mean they can tell you a story because they don't have structures. Data can be very clean, but there's still white noise. So like feature engineering, target engineering is definitely common grounds, regardless which models you use. 100% great point. Yeah.
Yeah, I mean, no doubt AI became a lot more accessible, which is great, but it also can be very dangerous because, yeah, it goes back down to the data quality. And also now another dangerous thing, I think, is that people use AI to clean the data without actually going line by line and understanding what are those outliers, what they mean, what story they tell you. And that can result in some very dangerous practices. So, I mean, foundational model risk management and data quality and governance are more important than ever. So as we're coming to a close of our panel, we have only a couple of minutes left. I wanted to ask one last question of the panel, which is, as we are heading into 2026, again, the cone of uncertainty is wide. There are lots of fragility, risks, wonderful opportunities. So what would be your kind of 1-minute advice on how to navigate this environment? Breanne, for starters.
Sure. I mean, I said it at the beginning. I'm really watching that tension, and I think patience is going to be rewarded in that, right? That tension between people who want to see earnings, they want to see results off of AI, but really understanding that these are longer-term secular growth trends, and so the patience will need to be rewarded. But just to pivot, one extra thing that I'm watching is I do think that very early this year with DeepSeek, it very much got laid out and laid bare that this isn't a one-horse race, that AI isn't necessary, or pardon me, the US isn't the only one innovating, right? Global innovation is happening. And we have multiple regions investing heavily into making sure that they're retaining sovereignty, that they're at leadership spaces in the innovation race. And I think that means that the global equities market is a really fascinating place to be watching, not just the US market.
Judith?
Yeah, sure. So yeah, if we're worried about is AI has overrun its course, and are we seeing a burst just like what we saw 20 years ago with the internet, or maybe 25 years ago? Well, I think we'll be watching a couple of different sectors like semiconductor infrastructures, cloud infrastructures, and specialty chemicals, robotics, automations. Watching the CapEx in those sectors, they can be a canary in the gold mine.
I think that, first of all, we still have a couple of months to go in 2025. And who knows what is going to happen in 2025.
Good
but
call.
What I would like to say is that when you think about your portfolio, the only thing which stands out for me is that you need to think about risk management, and you need to think about the preparedness of your portfolio to handle unimaginable, to handle things which you are not even able to think about today. This is super important.
Yeah, and I would say actually just kind of found what Breanne talked about is that patient capital, right? There's probably going to be more changes coming. There could be more volatility, but not to have a knee-jerk reaction to it, but to think it through, have a plan. So coming back to the phrase of patient capital and just take it slowly.
Thank you all for your advice and for time on this panel. And that's a wrap.
Thank you.
Thanks.
Thank you.